Hello, savvy investors, and welcome to House Lux Estate, your #1 source for all things real estate and investment. We're here to guide you through the labyrinth of property investment with our expert insights and proven strategies. Our mission? To help you unlock the full potential of your wealth. We believe in smart, calculated moves, so buckle up and get ready to elevate your investment game. Today, we are diving into a topic that's crucial to long-term financial stability: diversifying your investment portfolio. Investment diversification can seem like a complex concept, but it doesn't have to be. Picture a juggler with multiple balls in the air. Each ball represents an investment, and the juggler is you, the investor. The trick to effective juggling and investing is not to let all your balls or investments fall at once. This is the essence of investment diversification. This strategy is crucial for two main reasons. First, it helps mitigate risk. Just like our juggler wouldn't want to rely on a single ball, you wouldn't want to depend on a single investment. If that investment fails, you've lost everything. But diversifying your portfolio across various assets, such as stocks, bonds, real estate, and even commodities, ensures that a failure in one area doesn't wipe out your entire portfolio. The second reason is potential for greater returns. Diversification allows you to tap into different sectors and markets, each with their unique growth potential. This way, you're not limiting your profit-making opportunities. However, remember that diversification doesn't guarantee profits or protect against losses in declining markets. It's a strategy to balance risk and reward according to your investment goals, risk tolerance, and investment horizon. Investment diversification is like a well-balanced meal. You wouldn't want to fill your plate with only one type of food, right? Similarly, you wouldn't want to fill your investment portfolio with only one type of investment. Now that we've understood the importance of diversification, it's time to get into the how. Diversifying your investment portfolio involves more than just buying different types of assets. It's a strategic process that demands understanding, planning, and ongoing attention. Let's take a walk through the steps involved in diversifying your portfolio effectively. Firstly, understanding your risk tolerance is crucial. Risk tolerance is your ability and willingness to lose some or all of your original investment in exchange for greater potential returns. An aggressive investor, or one with a high risk tolerance, is more likely to risk losing money in order to get better results. A conservative investor, or one with a low risk tolerance, prefers investments that will preserve the original investment. Knowing where you fall on this spectrum will guide your decision-making process. Once you've gauged your risk tolerance, the next step is deciding on an asset allocation. This refers to the mix of investments you hold, such as stocks, bonds, and cash or cash equivalents. Your asset allocation should align with your financial goals, risk tolerance, and investment horizon. For instance, the younger you are, the more risk you can typically afford to take, meaning you may have a larger percentage of stocks in your portfolio. As you get closer to retirement, you might shift more of your portfolio into bonds, which are often considered less risky. The third step is selecting investments within each asset class. This is where the real diversification happens. In the stock portion of your portfolio, for instance, you'd want to include companies of different sizes, industries, and geographic locations. If one sector of the economy goes down, you're cushioned by your investments in other sectors. The same principle applies to bonds. Consider a mix of corporate, municipal, and government bonds. The final step in the diversification process is to regularly review and rebalance your portfolio. Over time, some investments may do well and grow to represent too much of your portfolio, while others may shrink. By rebalancing, you'll ensure that your portfolio continues to align with your original asset allocation strategy. This typically involves selling investments from overrepresented asset classes and buying more from underrepresented ones. It's generally recommended to review your portfolio at least once a year, but market conditions may sometimes necessitate more frequent reviews. In essence, diversifying your portfolio is a bit like building a well-rounded diet. Just as you wouldn't want to only eat fruits and neglect your vegetables, you wouldn't want to invest solely in one area and ignore others. A diversified portfolio can provide a healthy financial future, helping to smooth out the ups and downs of the market. Remember, diversification is not a one-time event, but a long-term strategy. It's a continuous process that requires regular attention, adjustment, and patience. But with careful planning and execution, diversification can help you build a robust investment portfolio geared towards long-term financial stability. While diversification is a proven strategy, it's not foolproof. There are common mistakes that investors often make. One such pitfall is over-diversification. It's like spreading your butter too thinly over a large piece of bread. Sure, you've covered all the surface, but is each bite satisfying? Similarly, having too many investments can make it difficult to monitor and manage your portfolio effectively. You might have a little bit of everything, but not enough of anything to make a significant impact. Then there's the trap of not rebalancing your portfolio. Imagine a seesaw with uneven weights. Over time, if not adjusted, it can tip too far to one side, causing an imbalance. The same goes for your investment portfolio. Market conditions change and the value of your investments can shift. If you're not regularly rebalancing your portfolio, it can become skewed, straying from your original investment goals and risk tolerance. Regularly checking and adjusting your portfolio will keep it in alignment with your long-term financial objectives. And let's not forget about ignoring correlations between assets. It's easy to think that if you have a wide array of investments, you're diversified. But not all assets are created equal. Some move in the same direction under similar market conditions. They're positively correlated. Others move in opposite directions. They're negatively correlated. If you're not considering these correlations, you could be in for a rude awakening when market conditions change and your portfolio takes an unexpected hit. By understanding and considering these correlations, you can better manage risk and potential return in your portfolio. Lastly, many investors often forget that diversification isn't a one-time event. It's an ongoing process that requires regular review and adjustment. As your life circumstances change, so too should your investment strategy. What worked in your 20s may not be suitable in your 40s, and vice versa. Avoiding these mistakes can make your diversification strategy more effective. Remember, diversification isn't just about quantity, it's about quality and balance. It's about making sure your investments are working together to get you closer to your financial goals. And so why go through all the trouble of diversifying your investment portfolio? Well, the answer is simple. Diversification offers a multitude of benefits that can enhance your investing experience and, more importantly, your financial stability in the long run. Let's delve into some of these benefits. Firstly, diversification reduces risk. Imagine placing all your eggs in one basket. If that basket falls, all your eggs will break. But if you distribute your eggs across several baskets, the likelihood of breaking all your eggs reduces significantly. This is the principle behind diversification. By spreading your investments across a variety of assets, you're less likely to lose everything if one investment performs poorly. Secondly, diversification can improve returns. While it's true that diversification can limit the upside potential of your investment portfolio, it can also limit the downside. This means that over time, a diversified portfolio can provide a more consistent and potentially higher return than a portfolio concentrated in a few investments. Remember, investing is a marathon, not a sprint, and diversification can help you keep a steady pace. Furthermore, diversification enables a smoother investment experience. The financial markets can be quite volatile, with prices fluctuating wildly from one day to the next. But with a diversified portfolio, these ups and downs can be smoothed out. This is because the good performance of some investments can offset the poor performance of others. So instead of experiencing the roller coaster ride of the financial markets, you experience more of a gentle cruise. Lastly, diversification offers peace of mind. Knowing that your investments are spread across different assets can give you a sense of security. It allows you to sleep better at night, knowing that you're not overly dependent on the performance of a single investment. In conclusion, the benefits of diversification are numerous and compelling. It reduces risk, improves returns, enables a smoother investment experience, and offers peace of mind. A diversified portfolio is your best bet for long-term financial stability. So there you have it, a step-by-step guide to diversifying your investment portfolio. We've taken a deep dive into the concept of investment diversification, understanding its significance and the steps to achieve it. We've also touched upon the common mistakes one can make along the way, and the numerous benefits that a well-diversified portfolio can bring to your table. Remember, the key to long-term financial stability lies not in putting all your eggs in one basket, but in spreading them across multiple baskets, or in our case, diverse investment avenues. It's a journey, not a destination, and every step you take towards diversification is a step towards financial security. So take that first step and let your investments grow with you, for you. If you found this video helpful, don't forget to like, share, and subscribe to House Lux Estate for more insightful content. Until next time, happy investing.